Hey, I'm Jeff from the Thoughtful Real Estate Entrepreneur. In this video, I want to talk with you about why seller financing, in my opinion and my experience, is superior financing for real estate investing overall. So let's just kind of start by hitting one of the sort of misconceptions or myths or misunderstandings about seller financing that kind of comes from all angles. This, as a buyer, this might be in your head right now. This is an idea that might be reinforced by other people you talk to. If you talk to realtors, for instance, they might also kind of reinforce this notion a little bit. And the idea is that seller financing is what you do when you can't get any other type of financing, right? And if you stop and think about that, what that is implying is that seller financing is sort of this inferior thing. There's the superior thing, but I can't get the superior thing right now. And so I'm just going to have to settle for the seller financing. And then maybe if I'm lucky, I can eventually switch over to the superior form of financing of a bank or conventional loan or whatever it might be. But that is totally not necessarily the case at all. And sometimes you'll talk to people, especially realtors, if you're looking at a property that's on the market, maybe you ask a question about possibilities around seller financing. Although if you watch these videos, if you listen to Racking Up Rentals, if you see anything else that I do ever, my encouragement will be not to try to buy properties that are listed where you're going to be talking to the realtors, but instead to put yourself in front of sellers where you can have a direct conversation. You can ask good questions, you can hear the right clues, and you can navigate towards a conversation about seller financing directly with the seller. But let's just say you are talking to a realtor. They might say something like, well, yeah, the seller might be interested in doing that or willing to do that more likely, for a couple years. So you could kind of get things together and then go get a bank loan. So there's this whole notion of just assumptions in people's mind that seller financing is sort of a temporary thing. It's an inferior thing, etc., on your way to what you really want, which is a bank loan. But I don't see it that way at all. That's not been my experience whatsoever. So I want to give you 3 reasons why seller financing is itself the superior financing mechanism that I hope that you go out there and you make a real priority and a real specific intentional effort to go buy properties in this particular way. So one of the main things is that in a seller financing negotiation, nothing is predetermined. There's not a lender who can send you a PDF that says, here's our lending parameters and our guidelines and our LTV thresholds and our debt to income requirements and our debt service coverage ratio requirements and our underwriting process. None of that is predetermined. When you're talking to a seller about seller financing, you're talking to a regular person. And this regular person, even if they've done this before and they have some thoughts about, what they're looking for in you, it's not this rigid. It's not this standardized. And so what does that mean? That means that you have a say in everything. You don't have carte blanche to just say, well, here's exactly how it's going to be, but you have a say in everything. And when I say everything, I mean there are a lot of little details that can go into a seller financing loan. We tend to think about just some of the big obvious things, like how much is the down payment going to be? What is the interest rate? How long is the loan term? I'd say probably a lot of people just boil it down to those 3 things, but there are so many little details of the terms that we can negotiate. I always, with my coaching clients, I'm always asking them to visualize a mixing board, like in a sound studio. Like if you went into a sound studio where they're recording your next favorite album, and there's an audio engineer in a little room sitting in front of a desk, and you look at the desk and they've got this thing that's like, oh my gosh, there's 8,000 knobs on this thing. How in the world do you know what each of these do? But you see them in there and they're just, I'm just adjusting that one just a little bit, and I'm just adjusting that one. And our negotiations of seller financing can be like that too. When does the interest begin accruing? Oh, well, we could just tweak that one a tiny bit. Oh, the interest rate. Yeah. So that's one of the more obvious knobs. We could tweak that one just a little bit. What is the amortization schedule? When does amortization begin? Does amortization begin at all? Are there different phases where there's some amortization and there's some not? There's so many little things. And the point is, with point number one here, is that none of it is like set in stone before you ever show up. So you have a say in all of it. And that is an amazingly powerful thing. You know, a bank situation is more or less, here's our program. The only thing you get to do, borrower, is say yes or no to our loan program. You don't get to, negotiate with us about, could we do 18% down versus 20? What if we did 18% down, but we bumped the interest rate a tiny bit? There might be some community banks or credit unions somewhere where it's just a tiny operation and you have some ability to have that conversation. But by and large, no, not at all. But with seller financing, every time it's all totally negotiable and you have a say in that. And that is a hugely powerful thing. The second thing is what I would call one-stop shopping. I remember the first time I heard the expression one-stop shopping when I was just a kid. And I think it was the store called Fred Meyer. And I don't know if they have Fred Meyer where you are, but I'm in Oregon where Fred Meyer started, and now it's part of Kroger. And they had this term one-stop shopping. And I remember asking my mom, like, what does that mean? And she said, well, it means you can go into this one store and pretty much do all of your shopping there, right? You need some motor oil for your car and some eggs and a curtain rod and some glue for your school project. It's all right there. So one-stop shopping. So what does that mean in the context of buying investment real estate or even buying a primary residence with seller financing, which, by the way, you can absolutely do too. Ask me, because the house that I'm standing in right now is the one I live in, and I bought using the same approach here as well. One-stop shopping means that when you get to yes with your seller, you now have all of the yeses that you need, right? Because every time we buy a property sort of the normal way, there's two things that we have to do. There's two things we have to go acquire. We have to go acquire an approval on the property we want to buy. And then we have to go acquire an approval on the financing that we need. And then we have to make sure that these two things come together and that neither of them before closing falls apart. And so now we need a yes from people over here who are not at all related to the people we need a yes from over here. And it becomes exponentially more difficult. Now, it's very normal, so we don't always think about it as being more difficult. But by comparison, when you sit down with that seller in their living room for the first time and you get to a yes on seller financing with the seller, and you walk out and you get back to your car and you go, wait a minute, I just got everything I needed right there. I got the property that I wanted and the price that I wanted or whatever. I got the financing that I wanted. There's nobody else that I need to say yes to. And also, what this means is the seller can't change their mind on one item versus the other, right? So back to when you have two different parties, a seller and a lender, either of them could start making waves and trying to change their mind and trying to change the game on you. And now all of a sudden you have these two things that are out of balance and not connected any longer. But the seller, once they've signed their name, they have just approved you for the property and the financing. So they can't change their mind on one or the other. They have approved you for both. And so it's like one-stop shopping that is shopping for something where there's no predetermined setup. You just get to actually work out the details with the other person in a way that works for both of you. And that is a super powerful thing. Also, one-stop shopping. Now, the third thing I want to share with you, this is all about flexibility. And I will admit, this is a little bit more advanced. And good news, if you are intrigued by the advanced stuff, there's way more things we can do to help you learn the advanced stuff too. But just a little forewarning, the next couple minutes will be a little bit more advanced. As a simple analogy, have you ever bought a tool? Let's say you went to Home Depot and you bought a saw of some sort or whatever, and it says right on the box, oh, it's got this feature and that feature and that feature. And you read the first 3 or 4 features. Yeah, that makes sense. But then there's like a couple features at the end of the list. You're like, I don't even know what that means. I don't know what that does. I don't think I'm going to use that feature, but you buy it. Well, there are tools, physical tools, like construction tools, that have features that as you become more skilled and more advanced and more of a pro, you start to understand how to use those features, and you understand that, oh, they were there for a reason, because they are actually valuable and important and powerful. And seller financing loans have the same things if you know what you could or should be negotiating into those deals. So let me just give you a couple simple examples that have been absolute game changers for me and for my peers who practice the same thing that I do, for the clients that I've had the pleasure of coaching that are now practicing this as well. And one of the first ones that is just incredibly, incredibly powerful is called a substitution of security provision, or a clause in a promissory note. What does that mean? Substitution of security. Well, let's start with the word security. What is the security of a loan? The security of a loan is a piece of collateral, right? If you just go down to Wells Fargo and they loan you money to buy a piece of real estate, that piece of real estate, you own it, but you are pledging that property as collateral to secure the loan that Wells Fargo has made to you. So Wells Fargo creates a document called a deed of trust, and it gets recorded with the county and where the property is. It says, hey, this person has pledged this property as collateral to secure their promise to repay this debt. It's what creates foreclosure rights and things like that, right? So security is the collateral piece of real estate that you are pledging to secure your promise to repay the loan. Substitution of security would simply mean there is always going to be a piece of real estate that secures this loan. But does it have to be the same piece of real estate the whole time? No, it doesn't actually have to be the same piece of real estate the whole time. If you have negotiated in advance, ideally, the ability to provide a new, updated, substitute, alternative piece of real estate. And of course, there are some rules around that and what can qualify. You know, you probably wouldn't have $1 million house as your collateral and then give yourself the right to, you know, substitute the collateral to a 200-foot vacant piece of dirt. Like those things are not equal. So there are rules that we install ourselves intentionally to make sure that the substitution of a piece of collateral or substitution of security is safe for everybody and it's still great security. But if you start to think about what it could be like to get a loan for a property and be able to move that loan, so to speak, move that loan around to other properties in your portfolio or other properties you don't even own yet, but you might in the future, right? What if you could substitute the security for a loan on a property you currently own and make the new collateral the one that you are buying in next month, next week? That might not at this moment, and that's why I said this is advanced, it might not click in your head and say like, well, I can see how powerful that would be. But trust me, it is. Have you ever thought to yourself, and I know a lot of real estate investors have thought to yourself, maybe you're doing a few flips. Why can't I go to the bank, get a loan from them? Let's just say it's like a $300,000 loan. And I'm going to use that loan to flip this property. And as soon as I sell it, they just let me take that loan and I'll move it to the next flip that I do. And then I sell that one and I'll take this property or take this loan and move it to the next one after that. Have you ever had a thought like that? Like, well, why can't we just kind of keep this going? Almost like a line of credit, right? I can continue to use it as I repay it. Well, a substitution of security clause isn't exactly like that, but on a practical basis, it allows you to recycle the loan itself to use with different properties over and over and over again. But you would not get that unless you know how to negotiate it. And you don't know how to negotiate it unless you have developed an appreciation for the flexibility that a seller financing loan could provide you. Like that provision, the substitution of security provision, is not a thing in the bank world. Like that's not going to happen. There's no need to ask. There's no need to try to negotiate that, because as we discussed in point number 1, there's really no negotiating. You just get to say, yes, I'll take your loan, or no, I won't. But a substitution of security provision is an example of flexibility that is tremendously, tremendously powerful. Let me give you a second advanced one that kind of goes with the substitution of security. What if you could take a loan? Let's say it's that $300,000 loan and it's secured by one property right now. What if you could take that loan and you could divide it into 3 $100,000 loans and secure them by 3 different properties? Now, again, without you spending a lot of time learning this and playing it out and and drawing out like a map of how this would work. Maybe it's harder to understand how powerful that could be. But trust me when I say it is very, very powerful to be able to do exactly that. And that too is a flexibility that there's no way it's coming from a bank loan, but it is absolutely a flexibility you can negotiate with the seller. So as we wrap up, seller financing is not an inferior solution that you just use as a temporary holdover, stopover, stepping stone, or whatever to get to the real financing that you want at the end of the day, a bank loan or whatever. It's not that at all. It is itself, if negotiated properly, the superior form of financing that I hope that you focus on learning how to find, negotiate, cultivate, and develop in your portfolio. Because reason number one, nothing is predetermined. You have a say in everything. It's all negotiable, so to speak. And that means that you have the ability to have influence on the outcomes of the details of that loan. And there are many details of that loan. Secondly, it's one-stop shopping. You get one yes from one seller on everything you need, and it makes your job exponentially easier. I mean, really exponentially easier and much less stressful, because you're not wondering till the second closing happens if the bank is going to change their mind, which can happen and does happen a lot. And number three, it provides you incredible flexibility that as you learn to appreciate the additional features on the tool that you're buying and learn how to use those, you start to see, wow, these flexibilities are incredibly powerful. And I'm so glad that I have that, because it really helps me scale my portfolio a lot better. Thank you for watching this video. Would you do us a favor, please? Would you please like this video? Please subscribe to our channel here. We are creating lots and lots more helpful, useful videos to teach you elements of the thoughtful approach to buying investment real estate. We talk a lot about relationship-oriented negotiation directly with sellers, a lot about seller financing, and all the stuff that makes you not dependent on what's happening so much in the real estate market or in the lending market, or having clout with brokers or not, and mortgage lenders and all that. We help you kind of avoid all of that, go around it by being able to go straight to the source of the yeses that you need to build a real estate portfolio. Thank you so much for being here. I'll see you in the next video.